Good afternoon, everybody. My name is Yrjö Koskinen. I'm the Associate Dean of Research and Business Impact at the Haskins School of Business in University of Calgary, and also the BMO Professor of Sustainable and Transition Finance. I would like to welcome the Canadian Sustainable Finance Network members and Pivot on Purpose Summit participants to this exciting session with Tariq Fancy. Tariq is the CEO and founder of the RUMI initiative. Before I introduce Tariq properly, let me do the territorial acknowledgement first. As we broadcast from Calgary, I would like to take this opportunity to acknowledge the traditional territories of the people of the Treaty 7 region in southern Alberta, which includes the Blackfoot Confederacy, comprising of the Siksika, Piikani, and Kainai First Nations, and Tsuut'ina First Nation, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Wesley First Nations. The city of Calgary is also home to Métis Nation of Alberta, Region 3. Please join us by acknowledging the traditional territories of Indigenous peoples in your own locations. So Tariq is the CEO and the founder of the RUMI initiative. It's of course very well known as the former Chief Investment Officer of Sustainable Investing and BlackRock, where he served as that role in 2018 and 2019. Tariq was responsible for the integration of environmental, social, and governance considerations across all investment activities of the world's largest asset manager, BlackRock. Now he's currently serving as the CEO of RUMI, which is an educational technology non-profit organizations that he originally founded in 2013. RUMI uses innovative and free mobile-based microlearning tools and reaches learners in over 200 countries, anywhere in their local languages through mobile phones. And interestingly, RUMI has been a subject of case studies both at INSEAD and Harvard Business School, the big case producers in the world. So that's a nice double whammy. So Tariq, let me start with you a little bit about your background. You're Canadian, but you were mainly educated abroad in the United States and in Europe. Of course, it's very common for Canadians to go to the United States for education. But how did you end up especially in France for your graduate education?
Well, thanks, Yrjö, first of all, for inviting me to speak today and to have this opportunity. I appreciate it. To give you a bit of background on myself, I have spent a lot of time abroad. I mean, it's pretty much in that sort of Canadian tradition of being an international Canadian who's anchored at home, but believes we have a role to play in the world. And so I think I had an interest in travel since I was young, because my parents were born and raised in Kenya. For there for generations. I was the first member of my family born in Canada, and so ended up doing undergrad in the U.S., a year of that in England, and then later, having worked for many years in finance, mainly in New York, a little period in Silicon Valley. I decided to take a bit of a break, and that actually led to me going to INSEAD and spending a year in France and Singapore. And it was an interesting opportunity to do two things. One was to sort of go and understand the differences and opportunities around globally around business, but other areas also. And then also sort of really start to lean into an area that I've always had a lot of interest, which was international development, and how we can take some of the tools we're building, whether they're financial tools or they're technology tools, and to aid development in places like Nairobi, where my parents were raised and got married, and in other parts of the world. So that was sort of the genesis of a lot of sort of where I've come.
So interesting. So you have this international background. You are born in Canada, but parents are from born in Kenya. You've been to England, US, France. So this your background. Does this kind of explain why you were so interested in studying RUMI in 2013?
Yeah, it really does. I mean, the RUMI thing came about because I had spent, so I graduated from school in the US. sort of had missed out on a scholarship, post undergrad scholarship in the final round. Didn't really know what to do, and so these banks come to campuses, and they're quite good at attracting people. I had been an early coder and had worked in technology, and actually had offers to do to do technology roles and coding roles. And so I ended up joining an investment bank that was focused on or a specific group that was doing large IPOs. So based in Silicon Valley, I accepted the offer in 2000. Started in 2001. If you remember, if you chart the Nasdaq, it was sort of, you accept the offer at the height of the party, and then you get there in time for the hangover. And so I saw sort of the end of the dot-com bubble was interesting, and then ended up working for a long time at a firm in New York that did distressed and turnaround investing. It's a really interesting part of the private equity or hedge fund sort of world, where you're looking at organizations, companies that often have good business models, but they mistime the markets, or you could do a turnaround, but you have to figure out all the pieces around it. It's actually much more intellectually fascinating, I'd say, than the average leverage buyout, because it's less of financial engineering and more of, you can't financial engineer if a company has negative 100 million of EBITDA, right? Like, you can't slap a multiple on it. So you have to really get in and understand it. And it's very sharp elbowed, because you're fighting through bankruptcy situations that can be quite acrimonious. And so my old boss, the founder of the firm I'd worked at, had been Carl Icahn's, the corporate raider, Carl Icahn's chief investment officer in the 90s. And so that gave me one example of sort of really seeing an extreme of, I'd seen the tech bubble burst. I'd been in the group that did the IPOs of Amazon, Google, really had this interest in understanding how to time things perfectly and turn business models that are broken into ones that work. It's a very, very sharp elbowed, aggressive side. And that sort of led me, I'd say, years later, to sort of really start to focus a little bit on, what did I actually want to do in life? It was more around development. It was around using technology for development. And so Rumi came about because in 2013, I had a very close friend in business school. He and I had both had this deep passion for using our skills, and mainly in finance and business, to some productive end for social good, which obviously doesn't really automatically happen when you're working at a hedge fund. And so we both kind of kept thinking we'd do something good for the world at some point. We kept kicking the can down the road because, we graduated from INSEAD and then went to, doing, back to finance, frankly. And I think Rumi came about because I had the idea for it. It was an echo of investments I had done years earlier to bring mobile phones into emerging markets as a leapfrog innovation, right? Which you could see the potential when the Nokia basic mobile handset at $50. And so, the impetus, to be honest, was that friend of mine, who was my roommate in business school, contracted stage 4 melanoma a few years after we graduated. And while fighting stage 4 cancer for 2.5 years, he went to Kenya. Actually, this is a blonde-haired, blue-eyed Dutch guy who went to Kenya because he really wanted to do something that he could be proud of and that gave him a feeling of purpose, right? And on some level, you can kick the can down the road and say someday, but when you have stage 4 melanoma, where it's really less of unfortunately, a question of your chances and more a question of time. It's really now or never. And so that kind of gave me the push to do Rumi, which was an echo of the mobile phone leapfrog, which is to say that, people had these Nokia handsets. Fine, I worked on that as an investor. Then you can see them upgrading the smartphones and basic low-cost devices. And you realize that the free digital learning revolution that has made an encyclopedia that I remember encyclopedias used to have door-to-door salespeople and cost $1,000, which I suspect most people listening to this are too young to remember. But if you look at that and you think, well, that's become free, and everything we learn at the age of 18 has become free, there's an enormous human potential of it. But the data showed that the people who have the most to gain from the free digital learning revolution were the least likely to access it. And that's where Rumi, began, and now has evolved into a series of products, including a micro-learning product that competes with and takes time away from social media, and is all driven by crowdsourcing, a lot of crowd energy, which is another key point. That when I was a tech banker, I would tell people that the most interesting model I'd seen wasn't Google and Amazon and the other ones we'd worked on early. It was actually Wikipedia, because I'd never seen or even thought of a nonprofit using their tax status as not just in a way to help people get to give donations and get a tax receipt, but also actually to build an army of people who are willing to work in a dispersed way for for public good. And so that's intrinsic to the Rumi model of how we bring microlearning to people's phones, that it's actually driven by skilled volunteers. And so that's all what kind of led me to the other extreme, which was how do we create, how do we create social impact, right? So it's the vulture investing world, definitely one extreme. It's the sharp and sell part of finance, to like running a tech nonprofit where the bottom line is only creating social impact. Was an interesting trajectory because it gave me a sense of both ends of the spectrum.
So it's interesting. So with Rumi, you really combining your business technical finance skills with your desire to have a social impact, right?
That's pretty much it. Yeah.
So you were starting to Rumi there in 2013, and then in 2018 you ended up going to BlackRock. So I guess this must have been in the sense the same idea as with Rumi, that you would kind of mingle your business and finance skills with having social impact. Was that kind of the background why you decided to go to BlackRock?
That was it. Yeah, that was it. I mean, in a sense, I had a deep background as an investor, and as a principal investor. I had investments I'd worked on at, sort of had a track record of doing it that were very good in sort of this hedge fund private equity world in New York. I'd come back and spent a few years in Canada at Canada Pension Plan Investment Board, CPPIB.
Yeah.
And so in that capacity was helping to, it was a great opportunity to come back to Toronto where I grew up, and had been gone for sort of 15-ish years. And it was a growing platform where they were bringing a lot of, really skilled, great folks to build out new strategies that really leverage the capabilities of the platform, one of which is the ability to be very long-term and illiquid. And so doing that, I spent a few years building strategies then, and sort of, and then actually investing them. And so then I spent a period doing social impact, right? With technology based from the ground up. It grew and was successful. And that kind of led to me starting to have conversations with BlackRock, because there was folks, including the former CEO at CPPIB, who I'd worked closely with, who had gone over to BlackRock. It was then and now remains the largest asset manager in the world, in fact, in history. And so they were looking more and more around saying, how can we do sustainable investing in a meaningful way, right? And ESG and sustainable investing, they're kind of, these terms can mean a whole lot of things to.
Yes, we know, yes. Yeah.
Yeah, it's kind of everything to everyone sometimes. But in general, the idea is that you can start to look at ESG, and particularly environmental and social data, which is the newer thing that people think about, in a way that is useful for investing, right? And it can help returns, right, in a risk return basis, and ideally create some social impact in the process that's measurable, right, alongside your financial returns, which of course generally have to be competitive market returns. And so you have that goal, right? So you're trying to do the investment piece, and you're trying to kind of mix it with really looking at social impact data and creating social impact. And so I think, the kind of the way it found me was that the folks there had come to the conclusion that, to do both bottom lines at the same time, you probably need to have done each of them independently first, because they're tough, right? It's like kind of juggling and walking a tightrope, right? Both, they're difficult to do, right? Creating social impact or creating market returns. And so, the idea was that, like, if you've learned both of them independently, you might be able to sort of navigate doing both at the same time. And for me, that's how the role found me, right? It was that I kind of had connections. They knew me as an investor. They'd seen me do the social impact piece. And they said, listen, if Rumi's at the point where it can kind of run itself, would you be interested in sort of taking on a role where you can look over the largest pool of assets available in capitalism, and sort of actively try to manage that in a direction that can create both great investment returns, which is something I've thought a lot about, and then social impact, which I thought about. And so that's how it all kind of began. And they landed on hiring two senior roles to do it as a head and a chief investment officer. I was a CIO, right? So I was more of a practical hands-on role. The head, who I worked with very closely and was great, had been previously a senior advisor to President Obama and sort of the point person for the Paris Climate Accord, and is back now in government in the Biden administration. And so the two of us kind of started out trying to say, like, how can we, steer the ship in a direction that shows that this works at BlackRock and frankly works across the industry, which the ideal would be that unlocks tremendous capital and a tremendous ability of the system, and financial markets to, play an effective role in the solutions we need, both to the climate crisis, but to, broadly a whole bunch of other large social challenges. The most important of which I would argue are, climate change and inequality, which, threaten the planet and political stability respectively.
So it must have been really a lucrative proposal working for BlackRock, which, like you said, the largest asset manager in the world, get to work with high-profile people, and hopes to having a real impact on social issues, while also generating nice returns for your investors. So you stayed at BlackRock less than 2 years. So why did you become disillusioned so fast? What kind of what made you just, oh my God, this is not what I expected?
I think as I got in, I started to realize that I had drank the Kool-Aid, right? There's no way I was going in and taking on a role like that without believing that it could work. And I believed that it could work. And I think as I got in, I noticed that there was a lot of pieces that didn't make a lot of sense. It was just historically this function at a lot of large firms, including at BlackRock, had been run by the philanthropy team. That's a terrible idea, right? Because the last thing you want to do is go to a portfolio manager at a place like BlackRock or any portfolio manager, especially in places like New York. They're not known to be a humble variety of people, right? They,
that's an understatement, right?
Yeah, exactly. And I say that having been one, right? So I understand the mentality. They are very competitive, right? Think of them as competitive athletes on a field this is the Premier League, right? They're fighting to score goals or maximize points, and they have a singular measurement. It's return, or really it's risk-adjusted return, I think is the simplest way to look at it, right? It's a single metric they're trying to focus on. It's like a basketball player. They know that you win by points, right? There's other stuff that flows in. You can't kick people in the face because you're going to get a foul, and there's rules around the game, but within those rules, there's one scoreboard, right? So they're very competitive. And so the previous lead had been sort of the philanthropy team coming in and saying, here's why you should do good things for the world. And a lot of them, they said, listen, if we're not focused on doing good for the world, we're focused on returns, right? And they're not bad people. This is the ridiculous part about sometimes, well, they can do more. No, they can't. They have a fiduciary obligation, right? A legal obligation to maximize returns as measured in dollar values, not social values, right? And so they're focused on return for a good reason. They're legally obligated. Also, they're financially incentivized. Their compensation relates to it. So if there is a way for them to do, allocate capital to good things in the world, they're going to be doing it, right? And they're not going to do it because it's good or bad. They're going to invest in Tesla, not so much because they think it's like, because by the way, it's going to help us build electric vehicles. That's a nice to have, but ultimately they're focused on return. And so what I started to realize was that as I went in, and I'd been a former investor, and the sustainable investment space didn't have a lot of people with an investment background. I found it to be a bit unusual because it'd be like, I use in the paper analogy to sort of, if you go to an ethical programming conference and then you realize that like nobody in the room had ever written a line of code before. I'm not saying everybody needs to be a coder, but like you probably need to have a few people who have that experience. And so as I got in, I started digging in, and I talked to all of our PMs, and this is the biggest investment manager in history. I've done different strategies. I've invested across debt and equity in different markets. And they were very honest and open with me. I started to realize that ESG data didn't have that much value to investing. Like what the public believed, and what, sort of that ESG data has become this magical godsend that every investor has to focus on, wasn't reflected in reality. And it wasn't reflected because, first of all, if you have first of all, ESG data is very difficult to measure. It's getting better, and that's good, but ultimately, it's the kind of stuff that it's like, the E is a bit easier to measure than the S. Again, the G I would leave aside because people have known about corporate governance being important for decades, but it's the E and the S that was really growing. And I started to realize that the reason we were talking about ESG data so much wasn't because of its value to investment processes, because I could look and I could understand the data, but I could also compare it to other data sets, having invested before ESG was really a thing. It seemed to me that we were talking about it because it included the words environmental and social at a time that society is demanding movement on these issues, rather than because it had that much usefulness as a data set. And again, it's not that useful because it's hard to measure these things, right? Number one. Number two, and this is really important, short-term investment strategies don't have to care about these things, right? It's not enough to say, okay, in the long term, these companies have to care about climate change because otherwise their business will get destroyed. Yeah, that's true. That's fine.
Yeah, absolutely. Yeah.
We'll go to PM who has like a 3-month hold period, and they'll say, that's true. Like I had ones that tell me this, listen, I believe in climate change. I want to do something about it, but I'm focused on like 3 months out or 6 months out with liquid, corporate debt. And they would be very clear that most of that data wasn't meaningful from a risk return basis. It is meaningful to society, right? But in 10 or 20 years. And so if you have a disconnect between, their incentives and, what is in the public interest, the market can't correct that on its own. And I think the biggest challenge I saw was that, frankly, it's not that profitable to be responsible, right? There's this thesis that's been built in the last few years around stakeholder capitalism, around ESG will do all these good things. And I started to realize, I kept getting asked how this creates any social impact. So I sat back and I said, I got to write a paper white paper to explain this. Because the CEO, my old boss, Larry, would basically have these letters and they would say, the ESG data is great for the world and we're going to do more of this, but there wasn't really that much behind it. Right. So I'm trying to write this white paper. And then at the end of it, I realized I've written this tortured argument that the market will self-correct, in response to climate change, which is the greatest market failure in history. And that's really what it is. There's a lot of free market self-corrects sort of things. And unfortunately, what the recent Facebook whistleblower told us, right? And one of her comments I thought was interesting. She said, listen, time and time again, we would reach this point where Facebook would be given a choice between maximizing profits and doing what's in the public interest. And every single time they would pick profits. Call me a cynic because I was a former vulture investor, but I'm certain that that's the way the system works across the board. Not because of individuals. I mean, although there are individuals like the Zuck who probably be doing a better job of what they're doing, but it's really the system. You have corporations built with, since Milton Friedman wrote in 1970 that shareholder primacy is the goal, who are the divisional, P&Ls, budgeting, incentives, legal obligations. From the ground up, they're constructed to extract profits. And so what the Facebook whistleblower said is that they're going to pick profits every time. I saw that at a systemic level, right? I mean, ultimately, it's not that profitable to be responsible because if there's no, particularly with climate change, if no one is forcing you to pay the cost of the pollution that you're incurring on society, and there is a cost, right? It's just going to society and future generations. But if no one's charging you that cost today, right? So the market failure persists and it's cheaper to burn fossil fuels than we need for it to be over the long term. And you have a system where everyone's locked into financial and legal obligations and incentives where they're going to maximize profits measured in dollar values. Any way you look at that, that system is going to produce suboptimal outcomes because every single PM is going to tell what I saw at the biggest investment manager in history. They'll say, listen, I have to go where the return is. And the return is, frankly, more in a lot of these areas we don't want than we need for it to be. And it's a terrible mechanism to have, big asset managers, solving social issues. It makes no sense, right? I mean, political philosophy 101 is they don't have democratic legitimacy to be making those decisions. And when you ultimately have a position where the short-term incentives of business are misaligned with the long-term public interest, that's where government has to step in. They have to step in and internalize those externalities. And we haven't seen that because it seems like we've been beholden to a set of narratives since the 80s that, came out of the Thatcher Reagan era that tell us that the only solutions come through the free market. And so, ESG is all around either divestment, which has no impact. And I would argue is a waste of time and energy. It's well-intended, but it's zero impact on reducing emissions. And now everyone's moved to engagement. Let's engage these companies and tell them to do more. And that's still, those are only the two options that exist if you have the horse blinders on from the 80s. There's a third one that makes a lot more sense, and it's clearly regulation. And the heaviest lifting for solving our social challenges have to come from government. And that's something that I started to realize very early on at BlackRock was that the system was never going to self-correct because even if there's 1,000 portfolio managers who act and operate like I used to act and operate when I was a PM, the 1,000 are not going to do what we need them to do. It's not because they're bad human beings. It's because that's not how the system is structured from an incentives perspective.
So I have a corporate finance background. So I mean, I always found it peculiar when asset pricing people talk about that certain strategy brings excess returns over risk-adjusted returns, because we know that financial markets are very, very competitive. So if one strategy works for a little while, people will start copying it, and those excess returns will disappear. Nothing works that long in competitive markets. So I think that's a little bit of a wrong metric. And I understand when you're selling your products, you said, oh, well, we're going to generate these fantastic returns. But past performance is never guaranteed that future performance will be great. But what we know from studies is that not necessarily sustainable investing, but sustainable activities by the firm have a tendency of increasing valuations. So increasing, let's say, whatever is your preferred valuation metric, enterprise value over cash flow, or market value related by book value. Those firms that are investing in ESG activities, at least when they are material, tend to have a positive impact on your valuation. So the level, not necessarily returns, but on the level. So there is at least some evidence, and for some it's fairly rigorous, not just correlation, but causation. So I'm a little bit more hopeful than, I understand that, I would never promise anybody alpha or higher returns, because the world is competitive, and those will be competed away.
I'd agree with that. In my experience, there are areas of the market that are inefficient. Of course, that's
We don't believe that markets are always completely efficient, right?
Yeah, exactly. And I think that what underlies market inefficiencies, a few things. One of them are long-term narratives, right? If you have one of my favorite books I read last year was the Yale economist Bob Shiller's most recent book, Narrative Economics, and he talks about how narratives affect mass psychology. And people keep repeating, real estate only goes up, or Bitcoin, this, that. He talked a lot about crypto, and sort of how these narratives infect the system, and they cause mass irrationality for long periods of time. That sort of, sort of reminds me of the Keynes quote, which is that the market can stay irrational longer than you can stay solvent.
Yeah,
which
famous quote, yes.
Exactly. There's a lot of NFTs and crypto that look to me like just digital Ponzi schemes, but that doesn't mean they're going to crash tomorrow, right? I don't think all of them are going to survive the long term, put it that way. But they can persist. And I think the other areas where you have certain market inefficiencies, where there's a supply-demand imbalance. So having done distressed investing, we would raise money with the idea that there's going to be a crash and so we raised a $3.5 billion PE fund in 2007. We said, listen, we don't know when this thing is going to blow up, but if you look at credit metrics and everything else, this is not sustainable. And so you knew something was going to come that was bad. But the idea was that, when it comes, markets overshoot on the way up, they overshoot on the way down. And you have a whole bunch of, mutual funds that are forced to dump bonds because they're being downgraded or whatever. They're all puking it out at the same time. And if you have a few buyers that have long-term capital and they're waiting, they can actually go and buy these things. And so you do have market inefficiencies in certain areas, but I think ultimately, and that makes me wonder about like divestment and all these other things. So I think, well, who cares if someone sells the shares of the oil company? Like we were waiting for stuff like that. That was like literally what a whole segment of the market is looking at. And really, what they look at is they don't really care about the short-term sales prices of shares. They care about the long-term profitability, right? If a barrel of oil is going to sell for what a barrel of oil is going to sell for, and we have not affected the profitability of that model because we haven't added a carbon tax and they're not paying the cost of pollution, then ultimately the short-term share price can fluctuate. And sometimes you'll get, ESG prices going up, and maybe the fossil fuel players will get sort of depressed. But I would argue that's probably because of a belief of regulation occurring, right? Because ultimately, if they could keep making money off selling a barrel of oil at the exact same price that they have, the divestment idea, which underlies all the ETFs and most of sustainable investing, which is that, either I divest or I buy a basket of securities that tilt away from them, an ETF, whatever, or I don't own normal bonds, they only own green bonds, whatever. All of them, they don't affect the underlying profitability of the model, right? Because society is the same way it is. You could still keep doing these things. And so short term, you might get share prices that go up and down, but I would argue that the only way that rationally makes sense to me, if no one's internalized the externality on their core profit model, is because somewhere out there, someone is saying that not just a transition is going to happen. We all know this transition is going to happen, fine. but it's because someone believes that, the ESG shares or whatever should be higher because someone's going to regulate that and internalize the externalities. So from that perspective, if you believe there's going to be a carbon tax, and there has to be, right, everywhere, not just in Canada, in the US and other places, the question is when and how much time we waste on the path to doing that. Then you believe that someone's going to internalize the externality, and then maybe there's a ability for the market to sort of try to get ahead of that. But and that's, I'd say, the promise of ESG on some level is that it goes from something that is being misused as a set of tools and data standards that actually, could be useful, but it's being combined in this nonsensical free market self-corrects thesis, where people say, well, ESG is the answer. If it turns into something which I hope, which is ESG 2.0, where you have more rigor around it, you end up in a place where, ESG assets will potentially outperform because, instead of serving as a placebo that delays government action, it's a complement to it. And then in that world, ESG could actually do quite well, right? Because it's like sort of being the sports player who plays clean, right? If you know how to play cleanly and win cleanly, and then actually the referees come back and start doing their job and penalizing bad behavior, you're better off, right? An ESG fund, like, put it this way, a low carbon fund is going to do better if there's a carbon tax relative to the regular fund. But if there's no carbon tax and no one internalizes the externality, a lot of that opportunity goes away. And in that level, I mean, I always come, to your point, it's long-term returns and core profitability model versus the short-term valuation. That the latter can move based on multiples and other things, but there generally have to be that multiple and the other valuation tools generally ought to move with sentiment. And I think if you see impending regulation, that's a good reason for ESG assets to outperform.
And so one way that ESG investing and sustainable investing can play a positive role is that, assuming that there's even right now, like in the US, there is no carbon tax. But if there is some reasonable probability that down the line there will be a carbon tax, and that's going to affect the profitability of oil and gas companies or other polluters, it's going to be reflected in the price already. So in that sense, I think ESG investing, even in the absence of current carbon taxes, like in the US, we don't have any carbon tax in the US. We do have in Canada and in most of Europe. But so that sense, because why does the market are forward-looking? So it's so-called transition risk, and we already know that if you look at the oil and gas companies are hugely profitable right now. Canadian companies are more profitable than ever before, yet their valuations are low. Markets are already pricing the increase in Canadian carbon taxes in that. So in that sense, I think financial markets are very useful, whether it's ESG investing or just plain investing. I mean, investors are realize what is ahead of them.
Yeah, you're absolutely right. I mean, and there's an interesting question in there, right? I mean, to your point, the markets are already reacting to that. The markets would always have reacted to that. It wasn't like they didn't know regulation existed 20 years ago, right? I mean, before the acronym ESG became popular, portfolio managers in the market would have been reacting to the threat of regulation already, right?
That's
they didn't
correct,
need roles. It's just risk, it's risk mitigation. It's just intelligent investing. And so on some level, that's why we should question a little bit the amount we hear about ESG, right? Like, if you stop and think about how ESG has been sold, I would argue as an opiate to the masses, right? People are talking about,
that's a quotation for Karl Marx, right?
Sorry, yeah.
Hey, you're a finance guy, and now you're citing Marx. That's nice.
Which is funny. The truth is, I'm a capitalist. I'm a former banker, but I believe that competitive sports need rules, right? Otherwise, they devolve into nonsense. Markets need rules, and we know that, and we've always known that, and they just haven't been updated to serve the long-term public interest, right? And that's the challenge. But really, if you stop and you think about it, ESG is being sold to people as this wonderful opportunity and all these things. And you stop, and I looked at it and I realized this is just another data set, right? I mean, our PMs would already be using it if it's useful, and if they're not using it, it's probably not useful, right? Like, think of a place like BlackRock, the real assets team, long-term investments, physical assets. They're thinking 20, 30 years out. Of course, they're thinking about climate risks and climate change and ESG, right? They have to. And they were thinking about it before I got there. They said, thanks, we'll take whatever help we can get, but this is on our radar. Then you go to the other extreme, right? They're buying, government bonds, and they're just trading them liquid things short term. How do you think about ESG and, and sovereign debt? It's not an easy thing to do. It does not have a lot of return value at all, right? And they weren't thinking about ESG, and they weren't thinking about it because it was irrelevant, right? So somehow a data set that every investment team should already have been thinking about, and ought to, in theory would have thought about for decades before this, because if society's attitudes are changing, that's why ESG is important, or regulations coming, that's why ESG is important. All of those are things they'd be thinking about in the 80s, right? Why aren't they thinking about like society changing and government regulation? The only thing that seems to change is that like we pulled all this out. Some of that is good because you really focus on this specific data set that might become more useful in the future, and that can help us because you want to measure these things better. That's great, but like at the same time, we should be asking the question of like, how is it possible that capitalism had better outcomes socially and environmentally in the post World War II period, right? Again, better, lower economic inequality, and let's say in the U.S. and frankly in Canada also in the post World War II period, better environmental protection, right? Like Richard Nixon founded the EPA in 1970, like of all people, right? And there was no acronym ESG, right? I mean, it's like this government did their job, right? And it's like there's no acronym of ESG, even though we had better outcomes on these things. You had no parallel financial system of like higher priced premium green assets that were suddenly purporting to do what or to undo what the regular financial system is doing on a day-to-day basis. It's ludicrous, right? I mean, if you stop and think about it, when I go to the store and I'm trying to buy a baby seat, I don't have to think about if that baby seat's going to kill babies, right? Because like someone in the government's figured out that like this needs to be safe to be on our shelves, because the acceptable number of babies dying and then me not buying the product and the company going bankrupt, the free market self-correcting, that's not good enough. That's the acceptable number of babies dying is zero, right? If I go, that's why there's no lead in the milk at the grocery store. And yet when it comes to green things, the answer seems to be like, let's just have this green product sitting next to the non-green product, right? It's like the detergent, well, we'll have a green alternative, and there's like the sustainable, put the green paint on it, and now the sustainable, and you're expected to pay more for it. The exact same thing happens in financial markets, right? You say, let's leave the regular market the same because the answer is internalizing externalities. And you want to fight inequality and carbon emissions, it's going to be taxes and regulation, right? That's what the experts are saying. So no, leave that the same. Let's build this parallel system that is going to undo that stuff. And it has higher fees. And it makes no sense as a systemic change mechanism. And I would argue that it's morally reprehensible, because what you're doing is you're asking mainly millennials and younger people to go and buy green products that have premium prices in an effort to undo what is clearly a shared responsibility of environmental and social damage that's being done through private sector practices that clearly need to be reined in certain areas. And the worst part is they're paying for the privilege of doing it, which is clearly a shared responsibility, and where frankly older generations have benefited most from the system so far, arguably ought to pay a bigger share. And on top of that, most of those products have no impact, right? Because like an ESG ETF that's just like saying, oh, there's a bunch of publicly traded shares, here's a basket of them. And then they realize that, wait a second, if we actually adjust it a little bit and tilt towards a few more green things and a little bit less green things, which is soft divestment, and we turn around and take that basket, the greener basket, we can charge higher fees to socially conscious investors. And ultimately, all you've really done is move money around on the back end. There's no impact that you can believe coming out of that. I mean, these are all things that worry me, because I think that capitalism needs to be saved, and I don't think this is the way to save it. I think this is actually the way to use responsible business as a dangerous placebo that it has led to the fact that, I just turned 43 and most of the people younger than me don't believe in capitalism, right? If you look at the data, the oldest millennials are 40 and they don't believe in capitalism. Greta Thunberg generation is the most cynical young generation I've ever seen. I side with them. I think they're right? Capitalism can be fixed, but it requires us fixing the rules of the game. And that means governments doing most of the heavy lifting to change incentives.
So that is a very important point, but I think that's your point that the ESG is a danger placebo and opiate to the masses. I think that's a very, let's say, American perspective, in a sense that, I mean, I'm originally from Finland, and so I still waste a lot of time reading Finnish newspapers, and I used to work in Sweden, so I follow other Nordic countries as well. Nobody, no investment manager, no bank would argue there, at least, that we wouldn't need any government regulation. All the Scandinavian or the Nordic countries have carbon taxes. Europe has cap and trade. I don't know any asset manager in Europe who would argue against cap and trade or carbon taxes. And same in Canada. I've talked to a lot of chief investment officers in the major Canadian banks, and I don't think anybody argues about that the government shouldn't have a positive role, either carbon taxes or regulation or whatever. I think that's a very American perspective. So we don't need a government regulation of carbon taxes. I think everybody outside of the U.S. would say that okay, we need heavy lifting has to come from the society, but sustainable investing, sustainable finance can play a complementary role, not the main role, but can help achieve these aims. And that's why I mean, since you've been educated in England and France, that's I find a little bit peculiar. Your approach or your approach is very US centric. Of course, the US is an incredibly important country, and without the US on board, there will be no solution for the climate crisis. But the same can be said about Europe and the European Union and the UK. Without those kind of blocks, there won't be any solution to the climate crisis. And we have seen a tremendous progress in Europe in this front, so that where business and the government work together.
Yeah, I think you're right. I mean, I'd say, Europeans will definitely be farther along understanding the need and the role for government to play a referee-like sort of role. And I think Canadians, the Americans are clearly behind on that, and the Canadians were kind of in between. But, I mean, when I wrote the long paper you referenced, the secret diary of a sustainable investor, I used throughout it sports analogies. In it, I use basketball analogies to sort of communicate the incentives of the players in a competitive market as aligned to a competitive sport. And you'd be interested to know that I actually originally had soccer as a sport that I used. I'm a huge football fan. I spent a lot of my childhood with family in Manchester, England. And so huge soccer fan and was using analogy around soccer. I changed it to basketball at the end because I realized that the Americans probably need to hear the message more than anyone else. I say that as someone who spent, probably half my work career, most of my work career in the US and did my undergrad there. That's a message that need to be heard there. And because more than anything else, there are narratives, in particular in the US, that are very damaging to the sort of solutions we need, right? The only good government is small government, where you have like Grover Norquist and all these anti-tax people running around just saying that like taxes should always be reduced always. I mean, it's nonsensical, right? It's how are we going to pay for the roads and bridges and police? Some of them are, I'll give you an example. Ayn Rand, the great libertarian, I remember reading Alan Greenspan's memoirs, and there was an anecdote in there where he says that she told him that she thought all taxes should be voluntary, right? People should pay taxes. I thought to myself, like, what planet does she live on, right? I mean, and she's certainly not going to save this planet if that's the way she thinks we're going to get anything done, right? And so again, you have to be a little bit of a realist around it, right? There's a role for government to play, and no one wants to pay taxes, and that's fine, but it needs to be done efficiently, yes, but there's a role for that to play to invest in public infrastructure and to preserve the public interest. That message needs to be heard now in the US more than anything, right? So that's why I kicked off what I was saying with an op-ed in USA Today in March. I picked the most widespread US newspaper I could. And some part of it was saying, listen, we need to have a debate about the narratives that underlie this economic system, and particularly centered around the US. Now, I wouldn't give Canadians or Europeans sort of just a free pass. But I will say that I think that the US, unless the US leads, I think it's going to be hard for us to get much done. If the US took a leadership role on climate change, I think that listen, in Canada, no one, I mean, we just had an election. I don't think there's anyone who wants to appear to be seen to the right of the Americans on some of these major issues. And so the US led, I think politically, we would have to go along. The Europeans are already kind of more advanced, they'd be there. Then you have a real trading block, right? That you can start to get China and India at the table through, through trade mechanisms and border adjustments and so on around carbon. But if the US isn't leading, I don't know that you get the critical mass, right? I mean, we could do whatever we can do in Canada, and Australia can do something, but everyone has the same excuse, right? Which is that, well, what's the point of us doing anything if China is still coal and this and the other? So in some ways, I think in this decade, critical decade, we're in a place where the US has to take a leadership role. And I'd say that as a Canadian, we need to nudge them in the right direction, because if that market moves in, where we need to, it'll get us to where we need to go. Now, I know the next question, everyone's gonna say, wait a second, the US not gonna do anything, the political system is seized. Some people point out rightly that if business has short-term incentives and can't address a long-term systemic crisis, while politicians have short-term incentives also, particularly in the US, everywhere they have short-term incentives, they're trying to get elected, right, in the next cycle. And in the US, you have the unfortunate reality that there's tons of money sloshing around the system. And that money is going to prevent, any kind of meaningful change, because the more money you have in politics, and whoever, frankly, the people in power who collect all the profit streams have an almost unlimited ability to, behind the scenes, in a very opaque way that you don't even know what companies are doing, they're indirectly and directly lobbying to prevent and marketing, right, to own the message that, to stop the regulation that we need, because obviously if you have a lot of money coming into a profit model, you're going to cut off some of it to protect that profit model. It's the rational way the system works. And I think that's why the debate that needs to happen has to be in the business community, right? Yeah. Because in some way, it's like politicians having low short-term incentives, business has short-term incentives. But I would turn to business leaders in the US and I'd say, wait a second, like, yeah, but the politicians are begging for money, right? That's the first question to anyone who runs for Congress. It's like, how much can you raise? The politicians are begging for money and the business people have the money. So they all have short-term incentives, but someone's going to need to do the right thing and be responsible. And if business leaders are out there pushing neoliberal nonsense and trying to dress themselves in a moral cloak while they're doing it, the least we can do is kick off a debate where we say, no, like, take the moral cloak away. If you want to make money, fine. That's great, but then say it, right? But then don't sort of try to push lower taxes and regulations, sell crappy products to exploit social angst, and then also call it under the guise of responsible business, because that's dangerous.
But that is a very US perspective. Now, of course, we need, I'm an American citizen by now, and I'm also a Finnish citizen and just a permanent resident in Canada so far. I'm very, very pessimistic about the politics in the US. Right now, we have a Democratic president, Democratic Congress. Nobody's even proposing a carbon tax in the US. So if we wait until we get a carbon tax in the US, the game is over. So that's in that sense, we are in a terrible situation. Like Canada doesn't matter. Our emissions are 1.5% of global emissions. What really matters is the European Union, United States, and China. And we have to, if we get US on board, we can make a huge progress. But I don't know. I'm perhaps less optimistic about American politics than you are.
Listen, we're all pessimistic, right, on some level, right? Because they just, a year ago, the president was the guy who, in the midst of a 100-year health crisis, told people we should drink bleach, right? So, on some level, there's not a lot of room for optimism, particularly because, Biden is not performing at the level that I think most people would have hoped. And there's a real risk that the Republicans come back. And even if they don't, right, the political room that they have to navigate is very difficult. But that's kind of why I think the debate needs to start in the business community, right? On some level, politicians are going to respond to two things, right? Money, especially in the US, and the public attitudes and public opinion, right? Because that's what's going to get them reelected, and that's their ultimate bottom line every electoral cycle, right? So they're going to think about those things. We'll never get the public where we need to go. Both of those businesses doing the wrong thing, right? Businesses both paying money and behind the scenes, like in a sense, they're the athletes are saying good sportsmanship's the answer, and then they're paying the referee behind the scenes to not do their job, right? That's a hypocritical stance that I think needs to be illuminated. So number one, business is paying money to come up the system. That's a problem. And number two, if business is out there marketing that we don't even need, why do you need regulators and so on and so forth, and telling the public that there's a win-win solution that we can solve, we can go for, and telling the public, like, don't worry, we've got this, right? Stakeholder capitalism is the answer. The politicians are never going to do what needs to be done, right? So that's why I think the debate needs to start. And like, if you're a capitalist, what does responsible business mean to you? What does capitalism mean to you? Like, if it means kicking the can down the road on issues of the long-term public interest and selling placebos in the meantime to maximize shareholder value for the next few quarters, I would argue that's morally reprehensible. And I think that that's a debate that needs to happen within the business community. Because if the business community is honest about the fact that this is going to cost money, right? Climate change is not a blessing that we could sell our way of great green products out of it. I mean, there's a role for that, but ultimately it's going to cost in the aggregate a lot of money because we've built entire energy systems around extraction of fossil fuels. And suddenly we realize that we need to build a whole new thing. Yes, there's going to be jobs, there's going to be capital, there's going to be opportunities. Just like with COVID-19, you know, Zoom did really well in a bunch of tech companies, but in the aggregate, it's going to depress growth. At least if you have an honest message coming out and business leaders holding back on lobbying, they give the politicians the room they need, because now the public starts to realize, hey, this is we're going to take tough medicine to do this, right? You start to create the political foundation that you could actually get something done. And as far as the Republicans and all are concerned, I don't understand business leaders in the US don't have a leg to stand on if they say, I believe in the climate science, and then they're lobbying behind the scenes, and members of industry trade associations are lobbying against climate change. They're giving money to Republicans. I mean, that's bullshit. I mean, at the end of the day, if you believe in the climate science, they should be held to some level of accountability and say, okay, well, great. Then why are you giving money to politicians that deny climate change? Like, you can't have your cake and eat it too, right?
Yeah, that's true.
To me, that's why. So I'm not optimistic about US politics, but I'm optimistic that in the wake of a systemic crisis that we just realized we needed, you know, science told us to flatten the curve, and we needed government action to flatten the COVID curve, right? And then, you know, those leaders don't have a leg to stand on if they're out there saying that, you know, we should actually allow the free market to self-correct on climate change. It's a position that doesn't really make a lot of sense. And I think that the more that we pull that out and spark that debate, the more that we actually move in a direction that we could give politicians the room they need to solve these problems.
I'm much more optimistic about Canada. What I've seen is there's a huge change, especially in places like Alberta in the past 2 years. I don't think the companies, I mean, the companies are talking the talk a couple of years ago, and talking about, oh, we're doing great, we are reducing the carbon intensity of oil and gas. Now everybody's talking about net zero by 2050, actually reducing not just the carbon intensity, but the level of carbon emissions. So there has been a big change in Alberta. And I'm very much hopeful for Canada. Of course, Canada is not the US, it's one tenth of the size. But if change can happen in Alberta, change can also happen in the US, hopefully. And of course, I mean, oil and gas is I mean, of course, a gigantic topic in this province, and everybody realizes that it won't be a growth industry. And the question is how long can we still be burning carbon fuels, and that's a big issue here. So what's in this view? What is your sense of? You mentioned earlier divestment versus engagement. What is your sense that should investors engage with oil and gas companies and work with them to lower CO2 emissions, or would you just prefer that, okay, we are not investing in oil and gas at all anymore?
I think that engagement has a small role to play, but I don't think that it creates systemic change, right? To actually drive major change in incentives, you need to actually be able to, create a system where that change can happen easily by players who are financially incentivized and legally obligated to maximize returns. Because otherwise, there's a limit to what they can do. If the playing field is set up that dirty play is still, more profitable or scores more points than we need for it to be. So to give you an example, there was a lot of talk in the US around, this small hedge fund called Engine Number One.
Yeah, absolutely.
They fought this proxy fight against ExxonMobil, and they said, oh, like, we got 3 directors on the board. And I looked, I thought, like, how can that be solved? I mean, it's tough to think how ridiculous that is as a solution. We're going to fight proxy fights one by one against oil companies to convince them to be voluntarily more responsible. It's like, imagine in the 50s if, like, evidence came out that smoking causes cancer, right? So the answer was, oh crap, well, we need to regulate the sale of cigarettes, right? We need to make sure that they're transparent about the risks to the public. That's labeled clearly on the box. You regulate the sale to minors, right? It was regulation that saved lives, right? That saved lives of people who otherwise would have been, frankly, smoking would have been happening more into younger people, and more people would die to cancer. Now imagine if our solution to that wasn't regulation. It was that we should fight one by one proxy fights against tobacco companies to get on the board and ask them to voluntarily sell less cigarettes. I mean, it's their business model to sell cigarettes, right? Like they're going to have to be on some level forced to make that transition. And so that's where the question comes about, is it voluntary compliance or is it mandatory compliance? Well, the free market self-correct thesis we're being fed, including engagement, getting on the board of this company and convincing them to do the right thing, when of course you are obligated to maximize shareholder returns by definition of being on the board. That's a voluntary compliance mechanism. And I suspect that for, again, I think there's a real role for activist investors to play in convincing companies that in real estate or in food production or whatever, to do more around sustainability that they haven't done from a pure returns perspective, through the lens of a business case, because management's stubborn or they haven't thought about it or whatever. But if their core model is something that unfortunately harms society, then that's going to have to be mandatory compliance, because they're not going to voluntarily sell less oil barrels or less cigarettes. They're going to know that they're going to eventually have to, but that transition, I think, is going to have to be aided by government adjusting incentives, and not for nothing, aiding those industries in transitioning, right? I mean, Alberta is an energy, is sort of has a strong energy sector. I think most folks there understand science and realize the transition is going to need to happen. For that transition to happen at the speed that we need it to, and for Canada to be a leader, I actually think that there's a role, there's almost a role for Canada to play as a leadership player there, right? Because we are more likely in the US to understand that there's a need for government to play a constructive role and to work with them in a way that's not adversarial and, keep them at bay.
Yeah. And we do already have a carbon tax starting in and an increase in taxation until 2030. And now it looks like we're going to have a absolute limit on CO2 emissions from oil and gas industry. So and to me it looks like the at least the Canadian business and Alberta business are willing to work with the government. And so at least in Canada and in Europe, government and business and finance can be complements and work together. So maybe US is in many cases a special case, and hopefully the US will transition at some point. But I mean, we shouldn't generalize too much about it. Oh my God, they're still in Rand La La Land there.
Yeah, I mean, and here's the thing: the U.S. has always been a little bit more in that direction than other countries would be, but they've gone extreme in a direction that I think is going to turn back, right? Hopefully will turn back, right? Attitudes in some of the work I'd done after leaving BlackRock that I referenced in the long paper showed that actually Americans are expecting more of government now, and they expect them to play more of a role in the pandemic, because it's easy to ignore the role of government, and then you have a systemic crisis that only government can lead in solving, whether it's a global pandemic where there's special powers to close borders and make masks mandatory. Only governments can do those. I think for climate crisis, same thing. I reference in the paper an alien invasion and the 90s movie Independence Day. A systemic crisis, right? Government has to lead. I think Americans are moving more in that direction, but that I would say is the opportunity for Canadian leadership above all else, right? I wrote an op-ed in the Globe and Mail at the end of March after I'd gone public saying, I think this is where Canadians can actually lead, right? Because a lot of the data showed that we what I call the deadly distraction, which is all these ESG related narratives going out there and convincing the public that we don't need regulation, which is where I reached the conclusion that sustainable investing wasn't just not really helpful. It was actively harmful because it was a placebo that was delaying carbon tax and all these things. That deadly distraction was pronounced and statistically significant in the US. It wasn't in Canada. In Canada, you could show people these headlines, around business is going to save us and do all these great things. And they still said, that's great. We hope they do it. But that doesn't mean that government doesn't have a role to play, which is kind of like, they're hearing athletes saying, oh, good sportsmanship is the answer. And they said, that's great, do good sportsmanship, but like we still need a referee
rules. Yeah.
Right, exactly. But in the US, it actually delayed it. And so that's where Canada can lead, because there's a lot more of a constructive role around how government and the private sector can lead the way. I'll tell you honestly that I've had more constructive conversations with people who work in the energy sector in Alberta than I have with a lot of old school financiers in New York that, I spent my 20s, I learned to invest in the New York world. I'm not casting aspersions on them. I understand exactly what they think, But it was interesting to me because there's no question when I looked at their incentives that the financiers in New York actually were less threatened in some of these things than, the folks in Alberta whose core business model was driven around energy and who were most exposed to a carbon tax, because they're so concentrated in that area. And yet you could see that there was a conversation they're willing to have, and understood that, listen, we need to solve this problem by working together for the greater public interest. It doesn't mean that, that business gets eviscerated, but it also means it can't be business as usual, right? In the face of this crisis.
Yeah, business as usual. Yeah,
Exactly.
that's a dead end.
That's a dead end. And so that leadership can come from Canada. And I don't mean Canada just goes and enacts these things on our own and says, great, we've removed our emissions down a little bit. And then the US and everyone else does the same thing, because people in Alberta and elsewhere rightly point out that that's not a great solution. But it's more of Canada leading the way in coming up with these schemes and showing through the leadership what we're doing and bringing other players to the table and saying, like, this is a way that we can move forward and we can all do this. And Canadian leadership, I think, can return to an era of it did in the, sort of many decades earlier. We weren't just sort of an also ran in sort of a lot of these social causes where the most we can offer is sort of great optics and social media stuff, and more of like rolling up our sleeves and saying, let's get things done and show an example to the world of how, we can move in a direction we all want to move in.
Well, thank you, Tariq. This has been a very, very enlightening and interesting discussion, and hopefully, at some point, we can get you in person to Calgary once this pandemic is over and we may be in the endemic phase of COVID-19. We would love to have you visit us and in Haskell School of Business, and we could continue this conversation.
Thanks for having me.